What's up, guys? It's your boy Samuel Toshi, and in this video I'm going to show you guys how to manage risks properly on gold, because I noticed this is one of the hardest stuff to do while trading gold. You know, the high volatility of gold itself. So people really don't know how to manage their risks on gold. So today I'm going to show you guys how to do that correctly, so you always get an edge over the market. So let's get right into it. Before we get started, if you are new here, just do well to hit the subscribe button and turn on post notification to get notified whenever I drop new forex related videos. So with that being said, let's get right into it. Okay, so now what is forex risk management? Risk management is one of the most important topics you will ever read about trading. Okay, why is it important? Well, we are in the business of making money, yes, and in order to make money we have to learn how to manage risks, which is what potential losses. So ironically, this is one of the most overlooked areas in trading. Many forex traders are just anxious to get right into trading with no regard for their total account size. Okay, now when you trade without risk management rules, you are in fact gambling. So you are not looking at the long term return on your investment. Instead, you are looking for that jackpot. So risk management rules will not only protect you, but they can make you very profitable in the long run. So essentially, this is how risk management works. If you learn how to control your losses, you will have a chance of being profitable. So let's head straight to good risk management. So to get this done automatically, we'll be using my forex book position size calculator. Here's a link to the page. So this PDF, I'll be dropping it in the description box below, so you guys can go download it and study alongside while watching the video too. So now the platform for the analysis is TradingView, yes, as you all know. So let's use a trade I took on gold as an example. Okay, now at this is the trade here. So the current price here is 1938.63. So the stop loss position here is 1942.38. This is it here. And the TP position is 1925.00, which is this psychology area here. Okay. So now the stop loss, since you already, if you watched my previous video or you are still yet to watch it, um click on this icon above to go watch the video on how to calculate pips on gold. So you will notice now the stop loss is 3 points. Yeah, 3 points, which is what, 37 pips. Now you know 3 points is equals to 3 points equals 30 pips. So here you see 3.7 points and 373.7 here. So the main pips here is 37 pips. 3.7, which is 37 pips. Okay, so the stop loss point on this trade is 373.7, which is 3.7 points. Approximately it is what, 37 pips. Okay, now this, if you clicked on that link in the PDF, it will direct you to this particular page here. So it is my FX book position size calculation. So you just move to this currency pair, tap it, select the particular pair. For in this video I'll be doing majorly gold, because it's this video is centered on gold alone. So the currency is USD. Now you insert your account size, and the next space there is risk ratio percentage. So you put your account percentage you want to risk. For instance, let me say I have a 10k account and I want to risk 1% of 10k. So you put it here, and now you put the stop loss in pips. For instance, this trade here, we are risking 37 pips, right? So you put it here, 37. Okay, so is the link again to this particular page. So now, since we already know how to calculate how many pips we are risking, sorry, now it's time to determine how much we are ready to risk on this trade. It's advisable to risk 0.5% to 1% of your accounts per trade. let's say our account size is $10,000. So 1% of $10,000 is what? $100. So we are ready to risk $100 on this trade with no emotion attached to it, since we are not just trading blindly with no predetermined risk. Sorry. Okay. Now I've inserted the $10,000. Now the risk is what? 1%. The stop loss is 37 pips. So this traded size will change it from 0.001 to 0.01. So this is it. Traded size lot here, 0.01, not 0.001. So when you change it to 0.01, then you click calculate. Okay. Now you see the results here. You see we have changed it from 0.001 to 0.01. So now you see the result. It shows us the amount in money, in cash, that we are ready to lose. Sorry. So it's $100, which is 1% of $10,000. So the maximum lot size we should use is what? 0.27. So the maximum loss here we should use in order not to lose more than $100 is 0.27. So now in order not to lose this $100 again at once, that is, you use this 0.27 loss size and enter just one trade. If it should go against you, you just lose the $100 at that spot immediately. So in order not to lose this $100 still yet at once, we are to trade conservatively by splitting this loss to like 3 or 5 places. Let's say for example 0.27 divided by 5, you see it gives us 0.054. So instead of entering the trade with 0.27 loss, we can now enter 5 trades with 0.05 loss each. So first we go in with 0.05, then continue scaling in as the trade keeps moving in our favor. So that way you still be on top of the game. So we are only allowed to stack depending on the market's condition, which I will explain in my next tutorial video. Okay. So now, if you are not sure of the percentage you want to risk, or you are just or you just want to risk a particular amount, then follow this other method. Now, at this place of risk ratio percent that we put on, click on this swap with money. Okay, so you now write replace the percentage with the amount you are ready to risk. Let's say I want to risk $100, but I don't know what it is in percentage, right? So now I'll put $100 instead. So you see I've changed it to $100. Now still the same thing, 37 pips, 0.01 trade lot. So you click calculate. Now it shows you the risk value of this $100, the risk percentage of this $100, which is 1%. So still the same thing, 0.27 lots. So this is just pretty much simple. It shows you ahead of time before entering a trade um how much you will be losing if this trade should go against you. So it makes you free. It makes you trade freely, not those people trading blindly, like you just put any lot size and just enter the trade blindly. So this one shows you ahead of time that if this trade goes against you, this is the amount you are going to be losing. So someone asked me a question um on how to trade a small account using this method too. So I'll be doing a live example too after this video. I'll be doing a separate live video on how to trade $100 account below. Okay. So now remember this: the other secret to success in forex trading is entering a trade with good risk to reward ratio. So we are to trade a setup that has at least 1:2 above risk to reward ratio. For instance, this trade I took is a 1:3 risk reward ratio trade. So that is, I'm risking 37 pips to get 35 pips. It should be more than, because here you see it is 1:3.6. So not just 3 but 3.6, because I'm risking 37 to get 35. So if for instance okay, let's just, it is here too. So meaning that I am risking 1 to get 3. So I'm risking 100 to get 300. So with this, you will always be ahead of your losses. Let's say you entered 5 trades in a week and you lost 3 and won 2. So let's say your loss is 100 plus 100, which is the 3 trade you lost, equals to $300. Now you won only 2, which is, remember, you are using 1:3 risk to reward ratio. So those 3 trade and those 2 trade you won is, the first one is what, 300, 300 plus 300, so it equals to 600. Now 600 minus 300, you see, you are still up about with about $300. So you are still ahead of the game. So with the losses, you will still be ahead with $300 profits. Let's do another example. Now let's say your setup is always 1:2 risk reward ratio, using the same previous example, which means you always risk $100 to get $200. You're risking 1 to get 2. Let's say you entered the same 5 trades in a week and you lost 3 and won 2. So you lost 100, 100, 100, which is 300. You won 2, which is 200, 200, because you're risking 1 to get 2. So you risk 100 to get 200, 200. Okay, so you won only 2. That is 400. 400 minus 300 is $100. So you are still up with $100. So with the losses, you are still ahead with $100 profit. So that's it, guys, on how to manage your risks properly on gold. So more pips and cheers. See you guys on the next video. Thanks.